Okay, well, that segues us perfectly into Pro Picks, and we're going to start with a look at your past ideas. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, here it is, the moment we're going to get her to talk about Canadian natural resources. You picked this one, March 25th, 2025. And I don't know if you saw this, but on Twitter, there was this hilarious comment that said, find you, this is a man speaking, find you a woman who loves you as much as Rebecca loves CNQ, because that's how passionate you were about CNQ. And I bought it on that passion. I think Jillian, our producer, bought it on that passion to say, like, you made really compelling arguments, all of this. It's a great balance sheet, best operator, low cost, all of that. And then it did nothing. It did nothing for months and months, and everything moved. And then you came at a great time. The stock's up 36% from when you recommended it.
I hope you guys kept it.
We kept it. Okay. There were discussions, though. I was like, I don't know.
And as much as my husband hates playing second fiddle to CNQ, he owns it in his portfolio as well. So I think he's somewhat happy with that. You know what? Like, CNQ is going to be a name that I'm going to own for the next 20 years. So, we're talking about, last year and, what a stock is going to do. Yeah, for a full year, it did nothing. But what you didn't talk about is you were collecting 5.5% dividend yield. Because if you bought it, what did I recommend it at? Around $40, $45?
Yeah, it must have been.
Something like that. So, that was definitely a 5% yield. So yeah, you're collecting that. You're taking that money, reinvesting it back into that name that's going to be, at lower prices.
Yeah, it was around, I'm just looking at the date. Yeah, so it was around $45. Yeah, when you recommended it. It was 45 and now it's 60.
Right. We've been buying it for our clients. It hovered between $40 and $45 all year, for most of the year. And even actually in January when, the whole Venezuela situation happened, that stock opened, it was down 8%. So I'm like, all right, who's my new clients that don't own it? Let's buy some more. And it quickly from there, came up because.
So do you think it went too quick now? There's a big question right now about valuations in the energy sector and whether it's warranted.
So absolutely. Am I buying it at $60? Probably not, but I'm not selling it either because I'm going to own it forever. I would love it for it to come down a little bit more so I could buy more. But you're right. The reasons these energy stocks have done so well is because oil prices have done well. And a lot of the reasons oil prices have done well are not necessarily good long-term reasons. So for example, I kind of brought up those reasons when we were talking about Whitecap. So, has U.S. shale production capped? I don't know. We don't know that yet. That's to be seen. Is there geopolitical risk with Iran? Yes, but to be seen. So a lot of it is TBD. So I don't know if that move that we've seen is warranted, because could we see the oil prices retreat? Yes. And then we may see some retreatment in the stock price, but then I'm just going to be buying more.
There were some issues with CNQ around its ability to, outside of oil prices, its ability to be as aggressive on buybacks and returning money to shareholders, because it did have some spending plans. I think it's a poorly kept secret. They're buying assets from Tourmaline, and we're just waiting for kind of that announcement. As somebody who looks at things for income, for its ability to return money to shareholders, what were you saying about that criticism?
I think that I have full faith in such a strong management team, and they have done an amazing job of finding really good investments at rock bottom prices. They were buying assets in 2020. They bought it in 2015 when OPEC collapsed. So, if they're seeing undervalued assets, I have full faith in that. They also bought, an interest in Athabasca Oil Sands project last year, so their debt levels are higher. But that being said, they are also one of the best investment teams to return money back to shareholders. So when they can, they will. So they have gotten into points of time where 100% of free cash flow is being paid back in the form of dividend increases and share buybacks. So they will get there, and they will get there more quickly than we think. And especially if WTI prices maintain higher, like they're going to get there, within 1 to 2 years, and then they're going to go back to paying back 100% of free cash flow. So they're one of the few companies that have never cut their dividend, even when oil stocks went to, like, for a long time, went to $30, $40 in 2015. When oil stocks went negative in 2020, they didn't capitulate. Suncor cut their dividend. CNQ did not. So I have full faith, and they continue to raise it. Like, they raised it last year. So I have full faith that they're going to be able to maintain that dividend and grow it over time.
Okay, we'll call this a vow renewal that you and CNQ had. Okay, your other two ideas, we'll motor through them quickly because I want to get to your new ideas. Premium brands up 32%, nice showing. I think you caught it at a time where there was anxiety about its growth prospects, particularly in the US. Did that all pan out?
Yeah, no. So that one actually, because we own so many pipelines, it helped us buy this because retail companies, I guess, don't usually do this, but pipelines do. They invest a lot of capital initially for many years. So cash flows are down or negative as they're putting this build. But once that pipeline is in place, they can just collect that cash flow for years to come. Premium brands did a very similar thing. They have they had full capacity in Canada. There was a lot of growth opportunities in the US, but they did not have the capacity. So they spent about $750 million building and buying warehouse capacity into the United States. So on a short-term basis, they weren't meeting expectations. But for me, that's just like building. And now that build out is complete. They're able to grow in the US, and they have been doing so, and they're showing that trajectory. So I think we bought it at about $80, and then it very quickly went to $100, and I think we bought some more at $90. But yeah, so it's
still own it.
We absolutely still own it.
Now, AltaGas has also done well, not as well as the others. It's up 19%. And it's funny you mentioned this with Ryan. It was a little bit of a heartbreaker stock, a lot of stops and starts, and now it looks like it's off to the races. It's at a 10-year high. Will it reclaim its all-time high of 2014? I'm not sure. Maybe you have an answer. Do you think that it's a smoother path for AltaGas shareholders from here?
Yeah, I mean, I think, again, they've done a really good job. I think it's interesting why sometimes that stock comes off, or why it gets no love, is because it's a little bit in no man's land. Because is it a utility, or is it energy infrastructure? I mean, the truth is it's both. And so it probably doesn't fit into, let's just say, a traditional institutional investor that, wants to have like a certain amount in utility exposure and a certain amount. Like, you could buy a Fortis and a Pembina and then, kind of mix it together, and then you kind of get an AltaGas. I mean, we own all three of those stocks. But like an AltaGas, I mean, we like both of their businesses. We like the stability of the utility business. They have a lot of assets in that Washington, D.C., Maryland area, like WGL. It's done really well. Good rate-based growth. We also like the gas, the gas processing and business. They're building, propane exports off the coast of BC. They just issued equity that the market actually liked because it's going to maintain its ownership of a Mountain Valley pipeline that it's in the process of building. So, we like both sides of the business. They're both continuing to grow. For us, like, the return that it's been doing is what we expect, slow and steady growth. We don't really want to see our stocks double. It just makes it harder to buy more of it. We just want to see that consistency.
All right. Well, you've got to buy the dip opportunity with your first pro pick. Those are all your past picks. Your average return in less than a year is nearly 30%. So let's see what we can do here with your current ideas. Your first one is CAE, and this one is interesting. The timing is interesting because it's actually pulled back so far in 2026. It's down about 15%. But defense, right? You can think about it in the defense space, and it had some activist pressure. It wasn't last year. It was 2024 now. That really kind of got the stock off the mat. So now we're looking at it. It's a little bit down. What do you like here?
Yeah, it's funny. So CAE was one of the the first time I ever did market call on BNN, it was my top pick. It was at $24.
Now it's at 40.
Yeah, I liked it more at $24. At least I felt it had a better runway. I still like it here, and it's funny because back then, the defense was a write-off. I mean, it actually had no value.
Yes,
I mean, the margins they had legacy contracts with really poor margins, and no one really cared about that defense business. So that's a lot what's changed.
Because they also have civil aviation.
Yes. So the majority of, at least back in the day, like the majority, the revenues are, closer to 50-50, but the earnings, because the margins are much higher on the civil side. So the reason why we bought CAE was actually for the civil side, because the secular trends are great. So like the airline industry is basically saying that they need about 300,000 new pilots over the next decade. And all of those pilots are going to need, training over the next few years. And not just, it's not just a one-time training, because, when pilots are doing their training, they start on smaller planes and then they need a certain amount of hours before they can move on to larger planes. So as a pilot gets hired, we're looking at, multiple years of growth that's embedded. And it's funny because as dividend investors, this is one of the very few holdings that we have that do not have a yield, but it meets every other criteria because there's embedded long-term growth, long-term contracts. Because, I could just think off the top of my head, like in the past 2 years, they've signed deals with, WestJet, with the Royal Canadian Armed Forces, and these are all 10, 20-year contracts. So, they also they're not at full utilization. So again, you can have higher margins just through more utilization over the years. So there's a lot of growth embedded in that company on the civil side. On the defense, yes.
Well, I just wanted to bring up, because and I think part of the reason the stock's under the pressure is their order book on the civil side looked a little softer than expected. Do you think that's an overreaction?
Again, we're long-term, we're patient. So sure, is the market being impatient? Maybe. I mean, again, I don't worry about quarter to quarter. I worry about long-term trends.
Okay.
I mean, if you have 20 billion in backlog, whether it's going to be, a little bit less or a little bit, more in a certain quarter, I'm not as concerned. But, the other thing too is to look at the defense side. I mean, they have, Canada and all NATO countries have been ramping up their military budgets in the past year. And let's be honest, in today's geopolitical landscape, having a bit of exposure to defense can't be a bad thing. I joke with, I make the joke all the time. As long as Trump is in power, I want to have some exposure to defense. But, and again, it's not the reason we bought CAE, but it is a bonus right now.
Is it expensive?
Ooh, it's probably fairly valued, I would say, for here. What I would love to see is them introduce a dividend, because they were a dividend paying stock, and then the pandemic hit. And then, when airlines basically shut down, they cut their dividend. They probably won't, just because I don't think people care about dividends as much as we do. I don't think investors love dividends as much as I do. But I think they should put in a dividend, and that would at least, I think help in terms of valuation, or help create like a base to protect, the stock. But yeah, I mean, we've seen the stock come off from $47, like under 40, I'm buying it.
Okay. Your other pick is Algonquin Power, another, I would say a recovery stock that maybe hasn't recovered to its full potential, perhaps. Basically imploded in 2022.
Twice,
yeah.
But who's counting?
Yes, yeah. I was going to say, and then another implosion in 2023, and then it's just been kind of crawling along since then. Let's backstory it a little bit. What was with the implosion, and then why is now a good time?
The first or the second implosion?
Yeah, I know.
Yes. So the first time it imploded a few years ago, they were going to do a large acquisition, I believe in Kentucky, and it was around a time when interest rates were starting to move up, and so the fundamental, or the metrics, just didn't make financial sense anymore. They subsequently backed off on the acquisition, but I think the stock was already left for dead at that point. So that was and then they ended up cutting the dividend the first time, and so that was the first implosion. And then after that, they went through a period of really just getting no love in the utility space. Utilities in general were getting no love for those years. Interest rates were higher. And then you also had, the company was really in flux. They were had to get a new management team, like a new CEO. They also were in the process of selling their renewable assets. And so so again, and then they had a second dividend cut because they probably didn't cut. There was also, they didn't cut enough the first time. So that was part of the first problem as well. And they also got in trouble after the first cut that they should have cut more. All right, so let's look at where Algonquin is today, because it's a completely different company than where it was 5 years ago. So it is now, I would say, it is a pure play, almost a pure play utility. They did keep their hydro assets, which are worth more than their other renewable assets that they sold. They may sell that over time as well, but they are essentially almost a pure play regulated utility. So similar to like a Hydro One, Emera, Fortis.
This is in the last 5 years. You see.
And yeah, in the past 2 to 3 years, really.
Yes, yeah.
They have a new management team, like new CEO, new CFO. And I think the new management team is getting credibility. Like there was a new management team in place that is very experienced. They had an investor day. The stock popped, I think, 12% on their investor day. Like I do think the management is earning credibility with investors. I think investors are starting to creep back into the name. And the other thing, listen, we love utilities. There's no secret. Our biggest weighting is utilities for many reasons. One, it's defensive, but also there's just a lot of growth there as we're transitioning away from coal plants and into natural gas and maybe nuclear and renewables. There's a need for new transmission lines, there's new rate bases. So Algonquin is still one of the cheapest distribution utilities you can buy. It is trading higher now than it has been in the past year or two, but it is still trading cheaper than Emera, cheaper than Fortis, and definitely cheaper than Hydro One.
So here's a question. Did you own it through all these implosions?
We did. And most of our clients have a cost base of around $7. Yeah.
Because, you did this with Northland too. It's like, I think there's a teachable moment in here, if I can call it that. Like these kind of events, they are wash the weak hands type of events. People don't come back to stories like that. So I think it's interesting that you guys stick around on what is a lot of hair on these stories.
For better or for worse. But I do think for Algonquin, I do think for worse is behind them and the for better is ahead of them. And the other thing, and again, I would never own a stock just for this, but I think this could be a really great takeout candidate, right? Because
by who do you think would be interested? Any of those other players you mentioned?
I'm not sure if there's an appetite on one on I think there's an appetite on the private equity side or, pension fund, things like that. Maybe a Fortis or a Emera. I'm not sure. It's been a while. They used to do these really large transactions every few years and they kind of stopped, and it's kind of been nice to have a lot more stability with them. But yeah, a lot of Algonquin's assets are in the States, like Missouri, New Hampshire, California, New York, so maybe that goes into play because, Emera and Fortis do have more assets in the US than they do in Canada right now. So maybe it goes into that. I'm not sure. Hydro One is trading at a huge premium relative to the rest of the utility space, and they're predominantly just in Ontario. So some diversification could be good for them, to be honest.
Interesting. Okay, so a nice to have, not a need to have, or a cherry on top. In terms
if it
of
gets taken out, it's a cherry on top. But I do think they are doing the right thing with their regulated business.
So one story that has some hair on it now is your third idea, and that's ARC Resources. And recently it disappointed investors, though the stock has come back a little bit because it pushed, am I right? It pushed out the timeline.
I am going to completely disagree with hair on it. I actually know, but this is
from the market's perspective.
That's it. Yes, from an impatient market's perspective.
Okay.
Yes, it released earnings. The stock was down 10%. What happened? You're right. The rest of ARC Resources operations, great, fantastic earnings. Their guidance for 2026 maintained. What happened? They have one growth project. It is a big growth project, Hitachi, and they've had problems starting it up. There's geological issues. I think there's some flooding issues, water issues in the wells. So instead of continuing to deploy capital, the management did the most prudent thing they can do. They withdrew guidance for 2026. So they're not saying that they're going to stop producing. They just want to fix the problem first before they start putting guidance on it. Which is absolutely the right thing to do. They're trying to optimize the well design and capitalize the efficiency.
Do you think they will?
Absolutely. But in the meantime, the stock dropped so much that actually it was almost like the market was pricing zero for this project. But this project has value, whether it's going to be slower this year and, it'll be fixed next year or the year after. I mean, we're still invested. We're patient. We're fine. In the meantime, because they're not going to be deploying as much capital into the project, they're just going to be increasing their buybacks like crazy because they have all this extra cash flow. ARC Resources. So it's basically similar to a CNQ in the sense that it is the premium gas asset versus like the premium oil asset. But, they have drilling inventory of over 15 years. It is really the only leader in the Montney space. They have very low debt because they have so much embedded growth from the land that they own. They don't need to go out and start buying assets like a Tourmaline, for example, has to go out and buy their growth, whereas an ARC doesn't have to. So they have very high quality assets, very low growth. That one of their projects is going slower than anticipated. Okay, so if you're impatient,
but
sure.
It's a timing issue, you think?
It's a timing issue.
And the growth will come at some point from that asset.
Absolutely, I think so. And in the meantime, all their other assets are doing great. They also have a lot of optionality. So for example, like they have a Sunrise asset, which is dry gas. They have purposely shut in production, waiting for higher gas prices, sustainable gas prices, and they can just turn that on when, and collect for them there. Like they have a lot of optionality. We're positive on the natural gas space in general, just again, and utilities, because we do think a lot of the solution of increased power demand. And again, we're talking about AI, we're talking about industrial production coming back to the North America. We're talking about all these data centers. We need a lot of power. We need reliable power. Yes, some of it is going to come through renewables, but we also need efficient baseload energy. And the only options right now seem to be gas and nuclear. So we do think—
And you prefer ARC over a Tourmaline, which a lot of investors love to love, but hasn't done much, and a PBH.TO, which has done.
Yeah, we like, so PBH.TO, more dry gas. We like a little bit more of the optionality on the wet gas used as condensate. Okay. So a little bit more value there. We like Tourmaline. If you can own both, but we just own ARC.
Okay, Rebecca, it has been an absolute blast. Thank you so much for joining us today.